such a pleasure to be with you right here on the India Development Debate. This is a special edition and I'm Supriya Shrinate. Of course, inflation may be inching down, but the central bank is not ready to drop its guard against an unexpected price rise, raising the red flag over an anticipated spike in prices in the near term. The Monetary Policy Committee today did hike the benchmark interest rates by 25 basis points. RBI Governor Urjit Patel says apart from a sharp rise in crude oil prices, trade tensions and higher input prices could have a spiraling effect on inflation in the December quarter. The Monetary Policy Committee also expects the hike in support prices for farmers to add to the pressure that's building up. The good news is that the GDP growth projection for the current fiscal has been kept intact at 7.4%, even as there are concerns that have erupted on the export front. RBI's bitter pill for the economy is a big topic of discussion and debate right here on the India Development Debate this evening. I've got a very, very special panel right here with me in the first leg of the India Development Debate. Kaushik Das, India's chief economist at Deutsche Bank, V. Anant Nageshwaran, independent consultant, Banside Consulting, KK Mistry, VC and CEO, Vice Chairman and CEO at HDFC, and of course our consulting editor Maithili Basnurmat. So thanks each one of you for being with us. And KK, if I may really begin talking to you about the rate hike. I think people were divided along whether a rate hike was expected, would there have been a pause? Is this along expected lines, or did you actually expect the RBI to pause after the hike that happened in June? Because this is the first instance of back-to-back rate hikes since October 2013. And was this rate hike now necessary to avoid any more in the future? Is this, in some sense, hikes being front-loaded? Keki.
No, I don't think a rate hike was unexpected. My sense was, and I mentioned this in an interview a couple of days ago, that there would be a rate hike. Either it would happen now or it will happen in the next credit policy, which is October. But I would think it's more logical for RBI to sort of get it earlier rather than get it later. So if there is any positive impact that is to come of the policy in terms of controlling inflation, that positive impact is front-loaded rather than back-loaded. So I don't think it should surprise anyone. I think it was an expected thing. People could have been a little divided on whether it would happen now or it would happen in October, but I think it's a good thing it's out of the way and it's happened now. I don't believe there will be another rate hike in October, so at least till December we are done with the rate hike cycle. That's my view.
Indeed, that's your view, but I'm going to take it across to Kaushik Das. And Kaushik, two consecutive hikes, and yet the stance continues to be neutral. I mean, even in its commentary, there are 8 broad points that RBI has outlined that continue to be the risk to inflation. Of course, RBI has hedged it by saying that there are both upward and downward risks and each point has been justified. But two back-to-back hikes and yet the stance is neutral. Is that ironical at all?
Actually, we are not surprised, and actually we were the first one to call for a back-to-back rate hike in June and August. And as Mr. Mistry mentioned, it's better always for an inflation targeting central bank who's forward-looking to kind of front-load rate hikes. And if you see what has happened in Indonesia, they have hiked 100 basis points in a span of few weeks. Even the Central Bank of Philippines have hiked 50 basis points, and on August 9th, they're supposed to hike another 25-50 basis points. So all the all the Asian countries which have current account deficit are finding, pressure on their currency, given where oil is, given what is happening on the Fed rate front. And you would have expected all these central banks to act sooner than later. So in that sense, I'm not at all surprised by RBI hiking 25 basis points in June and then following through in August. As far as the neutral stance is concerned, I think RBI doesn't want to spook the bond markets too much, because even if your policy rate is at 650 today, currently bond yields are 10-year bond yields are at 770, which is almost 120 basis point spread. Which is too high even after the 50 basis points rate hike that has happened. So I guess they wanted to keep bond markets kind of in a stable range, and you're seeing that stability in the bond market. But what this rate hike in August does is kind of give some stability to the currency as well, because rupee was looking to blow above 69, and RBI has used a lot of reserves to push down rupee below 69, and this rate hike today has helped stabilize rupee around 68.50.
All right.
If RBI
Kaushik,
did
let
not
me
do
just
a
come
rate
in
hike,
there.
we wouldn't know the counterfactual where rupee could have gone.
Okay. Kaushik, let me just come in there, and I want to take this question to Maithili before I go across to Anant. And Maithili, Did RBI really miss the bus to cut rates post demonetization and is now perhaps just playing catch up and justifying this policy rate hike? I mean, I'm just trying to be the devil's advocate here. There was a large expectation that rates will come down when so much money flows into the system. None of that happened then. Is this a post justification really?
Actually, the Reserve Bank of India has now accepted, and Viralacharya admitted as much, that monetary transmission in India is not remotely as efficient as it should be, and that is why they've done the hike now, because it will take time for the signal to be passed down through the system. I wish the RBI had shown as much sagacity at the time when it was time for it to cut the rates. At that time, the RBI held back. So yes, I agree with you. They missed the bus at that time, and now it's not so much a question of making up for lost time as the fact realizing that given the fact that transmission does take time, not only in India but every country really in the world, monetary policy is a very broad brush blunt instrument, and in India particularly given the rigidities, it does take more time. So yes, they missed the bus earlier, now they are not playing catch up so much as being realistic. So I think there I would say that yes, the RBI has now realized that, and also as far as demonetization is concerned, Supriya, the market really did the job for them. Rates fell dramatically when so much of money flowed back into the system, but the RBI would have done well had it cut rates as well at that particular point in time. Unfortunately, they did not, and now, well, I don't know whether they're trying to make up or not, but now it is the right decision.
Absolutely. I'm tempted to go to Anand, but Anand, give me a minute because I just want to take one question that Maithili alluded to with Keki and then come back to you. Keki Mistry, do you expect banks and mortgage institutions to pass this on to consumers? Because, you know, Viralacharya did speak about transmission with a lag, but do you expect this to be passed on to begin with?
See, ultimately, I think they'll wait and watch for some time. It may not be very long, but they will wait for a little while. Because at the end of the day, lending rates are a function of cost of funds. So if cost of funds increases as a result of the increase in the lending rate, then I'm sure all the mortgage companies, the banks will necessarily pass on the rate hike to consumers. And at the end of the day, if the objective of the policy is to be achieved, then there is no point in the higher interest rate being retained at the bank level. It has to be ultimately passed on to the consumers. So over a period of time, I'm sure it will get passed on. Difficult to say whether it will happen right away or happen with a little bit of a lag.
Anand, tempted to ask you on transmission. It's never instantaneous. Post the rate cut, it's never done immediately. And here you have the Deputy Governor Acharya say monetary policy transmission happens with a lag. So there is a double speak of sorts there. But my larger question to you also has to do with the currency. You know, there's been conspicuous silence on the currency, and one understands that the RBI doesn't explicitly wants to talk about currency management. But in some ways, has this rate hike happened to prevent, to be a tool for further depreciation of the rupee? Is that one of the primary aims of this rate hike more than inflation? Anand?
No, I don't think this is a primary objective of the rate hike. I think the primary objective still remains inflation management. If anything, you can say this is a preemptive insurance that the RBI has taken out against a dollar strength, which could come for various reasons, which could come because of risk aversion, which could come because the Federal Reserve might end up raising rates aggressively. After all, they are meeting today. They may not do anything on interest rates, but Mr. Powell has spoken about a gradual rate increase for now. At one point in time, he may increase rates by 50 basis points, and there could be some stampede of emerging markets, in which case a rate buffer would help, as Indonesia and Philippines are doing, as someone pointed out earlier. So this is not about exchange rate. This is primarily about inflation. But exchange rates, you can call it a preemptive insurance, and that's not a bad thing to do at this point in time in the global stock market cycle and interest rate cycle.
Fair point indeed. I want to go back to Kaushik, and Kaushik, besides the rupee appreciation and all of that, you know, the full impact of MSP, and MSP has been one of the big factors that RBI would have budgeted in for as far as its own monetary management is concerned. It's been speaking about it for some quarters now. We finally have an MSP, which is obviously steeper than usual. But, you know, to assess the impact is still going to be challenging, because that will depend on the extent of procurement and implementation and, you know, what kind of kharif crops and all of that will be covered in that. Where do you see that impact on inflation be? Could it be as low as 10, 20, 30 basis points on inflation? Could it be as high as 70 to 80, 90 basis points, or even 1 percentage point on inflation? Because that's going to be the tricky assessment for the RBI to do going forward as far as inflation management is concerned.
Yeah, it's not just for RBI, it's for even professional forecasters, you know, trying to, you know, kind of gauge what would be the incremental inflation pickup because of MSP. As you said, like, procurement policy of the government is not yet clear, and even if they want to do a high level of procurement, whether it is possible to do so in a short period of time given the warehouse whatever you have in your kind of control. So can you ramp up procurement significantly if you want to do so? That's also a question we don't know. So we are assuming about 25 to 30 basis points additional pickup in inflation because of MSP, which could be on the higher side if procurement goes up. So factoring in all that, we are getting inflation averaging close to 4.7% for the financial year for FY19. And then we are building a 2% positive real rates on top of that 4.75 odd inflation forecast that we are getting. So your policy rate should be 4.75 plus 200 basis points, which is 6.75. So RBI has already given you 50 basis points rate hike. So probably another 25 basis points rate hike should be happening. And our view is that that next rate hike probably will happen only in early next year, probably in April. And I don't see RBI hiking either in October or December because inflation would be coming down because of a positive base effect. And in January-March period, again, inflation starts going up towards 5%. So probably RBI reacts again in April. And that would take policy rate to 675, which would be about 200 basis points higher than the inflation forecast that we are having at this point of time.
Keki, I don't want to make this a political debate, which is why we don't have politicians on the show. But just to quote former Finance Minister Pravin Chidambaram, who did react after the RBI policy hike, and he said that back-to-back increases do suggest that RBI does not believe in government's projections on inflation and deficit. Is that how you would interpret this rate action of today? Two back-to-back hikes. Is the RBI doubting the government's management of the fisc and also its projections on inflation?
My sense is if the inflation has to be controlled, then you have to front load the rate hike cycle rather than backload it. I remember some years ago when there was a possibility or there was an expectation that rates would be increased. Rates were not increased. That caused inflation to sort of move up very sharply. I'm talking probably 5 years ago. And then suddenly RBI had to come out with very aggressive rate hikes to sort of control inflation at that point of time. So it's much better to do a front loading of rate hike rather than keeping it towards the end and then running the risk of inflation shooting up and then trying to fight a battle which is very difficult to fight later on.
Okay, I'm tempted to take this to core inflation, but I just want to talk about the fiscal slippage for a minute now. And Anand, fiscal slippage is obviously a concern for the RBI, and it has said so emphatically both at the center and the state level. Is this hike in many ways also RBI's message to the government to borrow prudently, to be fiscally prudent, to stay on the path of fiscal consolidation, given there is an election year that we've entered in now?
No, I mean, it's possible for us to come up with any interpretation, and I don't think there is a particular trigger for them to be concerned about fiscal situation right now. It is an enduring concern with farm loan waivers, with the elections coming in various states and with the Lok Sabha elections due in 1 year's time, etc. But I don't think this rate hike cycle has been motivated by fiscal slippage. You could talk about current account deficit, to which fiscal deficit does contribute a bit, but it's ultimately this is about inflation. This is about protecting the rupee in the event of global risk aversion and turmoil, etc. I don't think this has got much to do with either the fiscal deficit or RBI not believing government's inflation projections.
You know, but I'm going to buy your point that the RBI is not doubting fiscal management right now, but that continues to be a talking point. I mean, we've already attained what 69% odd of our fiscal deficit targets. But you know, Maithili, want to ask you this question, particularly on the deficit, because deficit is a function of both revenue and expenditure. How disastrous will be the consequences if capital expenditure is indeed cut, and how grave are concerns on the revenue front? I mean, GST revenue, for instance, has been less than 1 lakh crore rupee barring 1 month. It has not crossed that figure. The asking rate is 1.1 lakh crore rupee. How grave is that concern?
Well, revenue considerations always are very important in a country like India, because we are so desperately short of revenue, given that our tax to GDP ratio is one of the lowest in the world, even among emerging market economies. And yes, GST numbers that we saw this evening were not very encouraging, and we have not reached that 1 lakh number, which crore number that we saw in the month of March. But you look at the numbers of April, May and June, every month has been steadily increasing. Of course, in the month of July, when we get the figures, we might see a dip, because the last GST Council meet did cut the rates on a large number of items. But overall, the hope is that as economic activity picks up and as there is greater compliance and less evasion, maybe those numbers will also pick up. So overall, I think we don't have too much cause for concern at this juncture. Yes, the fiscal deficit is close to 69%, but it's still less than last year. 69% of budget estimate as against 80% of budget estimate in the comparable period last year. So it's too early in the day to say whether there will be a fiscal slippage, but my guess is that there might be a small slippage, simply because as the election approaches, every government does tend to get more populist, and even though this government has always reiterated that it believes in fiscal discipline, I do anticipate a small slippage.
Okay, you do anticipate a small slippage there. Very quickly, and Kaushik, I'm going to come to you on this. The governor stressed in no uncertain terms on the need for macroeconomic stability by referring to the fact that we are at the beginning of currency wars. Is that a real threat as we speak? Kaushik?
Yeah, I mean, currency, the problem is if you see CNH or the Chinese currency has been depreciating, and dollar strength is also continuing. And also oil was on the higher side in the last few months. So these three competing things of dollar strength and CNY kind of depreciating and oil being higher has kind of impacted rupee. So if the CNH continues to move past 7, currently it's about 684 odd level, then obviously the pressure on the currency, all currencies in the Asian markets continue, and rupee will also kind of feel the pressure. So from that sense, what happens to CNH, and the Chinese are doing this to kind of offset whatever tariff impact would have on their exports and growth. So they're trying to offset that by currency depreciation. That is kind of having a lingering impact on rupee as well. And also remember, you talked about rupee and inflation. There is a link now because RBI is an inflation targeting central bank. And if oil prices are at higher levels and rupee is also depreciating, that adds to imported cost of inflation. And RBI's target is 4%. So RBI would need to kind of be cautious if oil prices are on the higher side, as well as the currency is depreciating. The good news is that Brent has started coming off a bit. Hopefully, if it comes closer to 70, that will give some comfort to RBI, but at this point of time, you have to keep an eye on how the Chinese currency is moving, and that will kind of determine where Indian currency is moving in the short term.
Hold that thought, because I mean, besides currency, the other grave concern has always been growth, and the governor has kept, and the RBI MPC, the Monetary Policy Committee, has kept growth levels of 7.4% intact. Mr. Mistry, are these projections slightly on the optimistic side, especially given the global environment? The governor himself says there are grave risks for global growth prospects amidst the trade wars, and even then growth figures have been kept at 7.4%. Are those slightly ambitious projections?
See, my sense is the macro environment in India today is not great, in the sense that oil prices have gone up. Crude prices going up is putting pressure on inflation, putting pressure on the currency. US is doing well, the rupee has weakened, so the macro is not looking great. But the micro in India, the corporate performances are actually beginning to look better. So we hear from banks that there have been initial signs of pickup in the investment cycle. So investments are beginning to take place. As I mentioned earlier, to my mind, a 0.25% increase in interest rates is not going to, in any material manner, impact the decision of a company whether to make an investment or not. So I think investments will continue to happen, and therefore, to my mind, that growth rate that RBI is projecting is not something which is not achievable. I think it's very much achievable.
Maithili, you agree with Keki there that growth rates are very much achievable, and it's not as if people will take a call given these rates. And I'll come to investments in just a minute from now, because the governor says we need to run a very tight ship on risks that we can control. So then why is the RBI or MPC not budgeting for big risks to exports? Because global or potential global trade wars that have been mentioned now in commentary will risk Indian exports. He said there are grave risks to global growth, but won't all of those risks impact our exports, and won't that in turn impact that 7.4%? Maithili?
Yes, I would think so too. Yes, I would certainly think so, and I would reserve my judgment on that 7.4, because if we saw recently the IMF in fact lowered the estimate of growth for this year. So I think 7.4 might prove to be an overestimate, particularly if exports don't pick up, and if at the same time we see a huge flight of dollars out of this country and sharp rupee depreciation, we might see a fall in the imports also, because mind you, oil is only one part of the import bill. We've seen large scale import bill being for non-oil imports, and that was all a sign of the recovery in the economy. So if in fact trade wars do happen big time and we have currency wars and outflow of dollars, I do think that 7.4 looks a little ambitious.
Anant, who do you agree with? Do you agree with Maithili, who believes 7.4% looks ambitious if there was indeed going to be this currency war and the potential trade wars, and we will perhaps not be unscathed and untouched, we will not be mute spectators? Or do you actually agree with Keki, who says, investment is not a function of just half a percentage point rate here and there, things will continue, and growth has nothing to worry about at 7.4%?
I think India's exports have been underperforming anyway lately. So we have to look at the marginal impact of export growth on GDP growth, because it has been an underperformer. It is not going to be an incremental drag on GDP growth. So on balance, I am comfortable with 7.4, but I agree with Maithili in one sense, that the downside, the risk to growth is on the downside. There is no upside risk to this 7.4%. So if you have to ask me to bet on a number, I would say the range between 7.2 and 7.4 looks achievable for 2018-19.
Okay, fair point indeed. Kaushik, if I may ask you, I'm not going to ask you the headline growth numbers, but what sort of an impact will these back-to-back rate hikes have on investment sentiment? I tend to agree with Keki that people don't take a bet on a project because interest rates have gone northwards of about half a percentage point. But even then, from a sentiment point of view, from a consumption point of view, demand was just about beginning to pick up. Capacity utilization has gone up. We are seeing the output gap narrow. And we're also seeing early signs of revival in corporate earnings. Given that scenario, how do you believe all those things are going to be impacted by these back-to-back hikes?
I think, markets will not react, or investment sentiment will not be negative. In fact, it's a good thing that RBI has hiked rates in June and August, because it helps to preserve macro stability. And it's not a question of macro stability versus growth. It's something which is, required for, getting, you need macro stability as a precursor for getting good quality and stable growth. So in that sense, I don't see any negative sentiment coming from the investment community. And remember that for the last 5 years, private sector has not invested in capex in India. And as Keki mentioned, that we are seeing signs of capacity utilization picking up, the demand coming back in the economy, and you would see this cycle turning, and possibly it will turn more after the elections are out of the way. But we are definitely kind of preparing for a pickup in investment cycle, and in that sense, market rates had already gone up in 2-3 months before even RBI hiked interest rates. So I don't think this 50 basis points rate hike does anything to temper that expectation. In fact, we are very positive on growth for this year. In FY18, we are looking for 7.4% growth on an average. There would be a trajectory that July-September growth would peak, after which you would see the trajectory kind of slowing down because of a negative base effect. But by April, June of next year, again, you'd be back at 7.5% odd growth. If anything, the risk for growth would be more for FY19. For FY20, if there is a big trade war between China and US, because these things take time to impact the real economy with a lag. So we are very comfortable with our 7.4% growth forecast for FY19. FY20, we have a 7.8% growth forecast.
Okay.
That possibly
Kaushik,
could have some downside risk if this trade war intensifies.
Okay, Kaushik, let me come in there. Quick last questions, and please keep them brief. Keki, let me start with you. You had said that you did not expect a rate hike up until December. By how much do you now see rates increase through the course of this financial year?
See, it's a tough call to make at this point because it's dependent on so many factors which are today not in our control. We have elections coming up next year, so that will create a little bit of element of uncertainty. That's number one. Number two, we don't know what's going to happen to crude prices. Crude prices have marginally improved in recent times, but they are still significantly higher than what one would like to see them. So given all, the US economy is doing extremely well, US is increasing rates. Now if US is increasing rates and if India does not, then you could see a massive flow of money out of India, which could put an even greater pressure on the currency, which is not something which is desirable. So I think given all these factors, it's very difficult to take a call over a 6-month time frame on whether further rate hikes will happen or not. But at least in my view, till December, we are done with the rate hiking cycle.
Anant, are you going to be as cautious? Are we done with rate hikes up until December and difficult to take a call over the next 6 months, or do you actually expect at least one more rate hike in this calendar year and perhaps one in the next, in the first quarter of next calendar?
I would assign a high probability to another quarter percentage point rate increase in this current financial year, but a slightly low probability of RBI hiking rates twice before March 2019. So one rate hike is definitely there, and if the Fed does 50 basis points by some chance later in the year and pressure on rupee mounts, then we could easily see two. So my prediction is 1 to 2 rate hikes before the current financial year is out.
Okay, Maithili, a quick last word to you. What are the factors that will perhaps play on the minds and the cues that RBI Monetary Policy Committee, the 6 wise men and women, will sit down and deliberate upon between the 3rd of October to the 5th?
Well, I think they would really be very concerned about the Fed hike. If the Fed hikes rates, and the chances are very, very high that it will, and the Fed statement is also very aggressive and suggests another rate hike by the Fed in December, I think then we will definitely see another 25 basis point hike certainly before the end of this calendar year. So they would be very concerned about that. Also, we know the impact of the stoppage of oil imports from Iran, because by November the US has told us we have to stop all imports from Iran. So if that impacts our oil price basket dramatically, that again will impact us. So I think there is a lot for the MPC to think about and chew the cud on.
All right, on that note, completely out of time on this edition of the India Development Debate. Thank you very much, Maithili Basnurmat, Keki Mistry and Nageshwaran, and of course Kaushik Das for joining us with your take on RBI monetary policy. The RBI has seen the writing on the wall. Interest rates have gone up for 2 consecutive policies now, but the stance continues to be neutral. RBI will be driven by data, and which is why it has given itself the elbow room to move either ways on policy stance. We take a breather and we come back with the next edition of the India Development Debate, the e-com draft policy. The online market, is there a level playing field, or is Swadeshi getting the better of it?